All right, so just as I predicted when the perma bears were telling everyone that the global economy was going into recession and that were starting a bear market here, the same thing that they um, say every time we have a correction in this bull market. Of course, they were wrong again as usual. As I said, this was a sideways consolidation in a long-term bull market. And I think most of these people really have no idea what even drives a bull market. Most of these people they remember the crash in 2009, and that's still vivid in their memory, and they're looking for the next shoe to drop. An excuse for why I see this a lot. The next recession is going to be bigger and worse than the last one. Well, it's not. That was a once in a generational event, and it's not going to happen again. So while there is certainly a monetary component to this bull market as central banks continue to print uh, incredible amounts of liquidity, there is also a fundamental driver for this bull market. It's the same thing that drives every bull market. It's a technological advance and another step up for the quality of life of human beings on planet Earth. The bull market in the 20s was driven by the invention of the assembly line and the automobile. The bull market from the 50s to the mid 60s or 40s to the mid 60s was driven by the invention of plastics and electronics. The last bull market from 1980 to 2000 was driven by the personal computer and the internet. And this bull market is being driven by a multitude of new technological advances: artificial intelligence, robotics, nanotech, biotech, autonomous transportation, clean energy, just to name a few. And most of these industries are still in their infancy or at best adolescence. None of these industries are mature yet. They still have many years to go. So this concept that we're in an everything bubble is just absurd. We're not. We're just in another long-term bull market as the next technological advance progresses. And we've probably still got another 10, 15 years to go before all of these industries mature and we get something that truly looks like a bubble. Now, that being said, we are getting extremely stretched. The repo crisis and probably just the Fed just naturally is probably going to dump a lot of print and dump a lot of money into the markets ahead of the election cycle. It's probably stretching this rally too far. I think it's too early for this to turn parabolic and get our bubble now. Like I said, I think we still got another 10 years. So I suspect same thing's going to happen with this as happened back here. We're going to have some kind of a mini crash event to close some of this huge gap between price and the 200-day moving average. And if I convert this over to the weekly chart, it's even more extreme. All right, so here's the weekly chart. I'll widen this out a little bit more. You can see just how extreme this is becoming. So, the Fed, central banks in general panicked. We had signs of the economy slowing down. They panicked. They started printing tons of money, and they have caused a breakout from this sideways consolidation, which was going to happen naturally anyway. But they're probably pushing it much higher than it really should go, and we're probably going to have some kind of a mini crash event in the first quarter of next year. Maybe we're starting to get along in this daily cycle, and I would expect it's going to occur at the end of this daily cycle. That's going to be due end of January, first part of February. So my guess is we're going to get some kind of mini crash event, possibly as we go through earnings season, when earnings just don't come in well enough to support this huge parabolic move, and we're going to get some kind of a pullback. So my guess is that that we're probably going to pull back to maybe retest this consolidation zone. Let me switch over to the S&P. All right, so I think it would be completely natural and normal for us to get some kind of a quick move back down and kind of retest this consolidation box that we've been in for a couple of years before we continue higher. And then moving on to the dollar real quick. If you've been listening to the Perma Bulls, well, one that comes to mind is Martin Armstrong. He's been wrong about this for 2 years. I personally, I don't see how fundamentals can apply to the currencies. We see all of these, this reasoning that the dollar has to rise because it's the prettiest pig in the pen, and the fundamentals are better for the dollar. The U.S. economy is in better shape than Europe, which is kind of nonsense in my opinion. That the dollar was in a bear market during the housing bubble from 2000 to 2008. So if that was a driver for the dollar, then how in the world did the dollar go down during that last period of extreme productivity in the U.S.? So I think currencies, my opinion for years has just been that currencies are mostly just the playground of central banks. It's become very apparent here lately. We just get these violent back and forth swings as one central bank after another tries to regain control of the currencies. Of course, the ECB and the Bank of Japan would like to push their currencies down and keep the dollar propped up. But we're getting the signs now that the dollar has topped and is rolling over into the next stage of the bear market. Let me widen this chart a bit. So I think this was the top of this. The dollar runs in about an 8-year cycle. So I think this was the top of this cycle in the dollar. You remember this was when everyone was calling for the dollar to go to 120. Of course, they were wrong as usual. And we get our first leg down in the bear market. And then we get this counter trend move. And I think it's been prolonged much longer than it would have naturally. I think the natural top probably came right here. But the ECB has been suppressing the euro and trying to keep the dollar propped up. So you can see it's just been crawling along this 200-day moving average, which would not happen if this was a natural bull market. There would be no scenario in which the dollar would be tagging the 200-day moving average so many times in a natural bull market. So I think this whole rally was artificial. Has been propped up by the ECB suppressing the euro and the Bank of Japan trying to suppress the yen. But I think that's probably done now. And we've got the classic signs of a bear market starting. We've got a break, strong break of that 200-day moving average, a retest that was not able to recover, and now we're starting to accelerate lower again. So I think the massive money printing by the central bank is probably going to overwhelm the ECB's efforts to keep the dollar propped up. And I think we are starting the next phase of the dollar's bear market, and it really shouldn't bottom until the next 8-year cycle low, which is going to be like maybe sometime in 2024. All right, so let me take this off here. So as the money printing increases and price starts to get stretched too far above the moving average in the stock market, more and more traders will become dumb money traders, and just all traders in general will become more and more bullish on stocks. And the smart money traders will be taking some profits, and then those profits will start to move into the commodity markets. And you can see that's already happening. This is gold. It's been in this long basing phase for 6 years. And we broke out of this basing phase. Here's our first leg up. We've tested our initial resistance zone. We're about to test that resistance zone again here. So I think some of the liquidity is starting to move into the commodity markets. And now let me move over to the energy market. So you hear a lot of talk about the inverted yield curve and how that guarantees the recession, and that is nonsense. Recessions don't just appear out of nowhere by magic. There has to be a catalyst for the economy to go into recession. If you want to check your history books, that catalyst has always been a spike in the price of energy, inflation, of 100% or more in a year or less. That increases the price of cost of living. So the middle class all over the world gets squeezed. They have a limited budget, and their budget cannot handle a huge increase in the cost of living that occurs very rapidly. So their discretionary spending collapses, and that's what historically always causes a recession. So while the collapse in the real estate market certainly weakened the economy, it was not the cause of the recession in 2008 and 2009. This massive, almost 200% spike in the price of energy. This just overwhelmed the middle class. Their discretionary spending collapsed, and that was the cause of the recession. So this is the exact opposite. We hear a lot of people say that deflation comes first, and then inflation. It's actually the exact opposite. Inflation comes first. That creates and causes the recession, and then you get deflation as the recession runs its course. So you can see right now that we don't have any extreme spike in the price of energy right now. So there is the inverted yield curve is going to give a false signal. We are not going to move into recession, not yet. Now, if the price of energy were to go to $120 over the next year, then yes, then we're going to be in jeopardy of some kind of recession in the year or two ahead. But we don't have that yet. But we do have liquidity starting to leak out of stocks and move into the energy market. You can see it here as the Fed really started to print money in September to protect against the crisis in the repo market. You can see some of that liquidity is landing in the commodity markets, gold and energy. So there is the potential there for a spike in energy. All right, and finally, this is the smart money, dumb money confidence. I've said many times in the past, I'm a contrarian investor. I want to sell when everybody else is buying, and I want to buy when everybody else is selling. So I wanted to be a buyer of precious metals recently, and I want to be a seller of stocks. They may still have further to go, but you can see from this chart the spread between smart money and dumb money is at the most extreme level it's been of this entire bull market. So at some point here, stocks are going to top, and we're going to get some kind of a crash event that should reverse this. It should scare the retail traders, and then make the smart money will get bullish again and start buying, and we'll repeat this process all over again. But this kind of a sentiment reading here, it does not make me want to jump in and buy the stock market. It makes me want to take profits or stay out of the way, because I would expect at some point this is going to reverse and come back up here, which would mean that the stocks are going to have a sharp correction. So while it may continue for a while in the short term, I don't want to be a buyer of the stock market. I want to be in the commodity markets. I prefer gold at the moment, but the entire CRB should do well as liquidity starts to leak out of very overvalued and overstretched stocks into the commodity markets.